How to Pay for the Green New Deal by Yeva Nersisyan and L. Randall Wray. War Planning and the Green New Deal. We provide a first attempt to quantify the net resource demands in order to obtain some idea of the reduction of current aggregate private demand, consumption, and investment that might be required to release resources to the Green New Deal efforts. That allows us to deal with what would otherwise create an inflationary excess demand. The main contribution we want to make in this paper is the argument that in assessing economic feasibility of the Green New Deal, we need to be focused on technological know-how and resources, not on the dollar costs. By themselves, the dollar costs do not provide useful information. There is no question, at least there should be no question, about the financial feasibility of spending even $93 trillion, the ridiculous estimate bandied about to scare the population, as the American contribution to a global mobilization to restructure our economies so that civilization might survive. Our analysis and the MMT approach in general is in line with Keynes's approach to economic planning for World War II, as explained in How to Pay for the War. Keynes rightfully believed that war planning is not a financial, but a real resource problem. The issue was not how the British government would be paying for the war, but rather whether the country could produce enough output for the war effort, while leaving enough production to satisfy domestic civilian consumption, plus exports, less imports. To estimate the amount available for civilian consumption, we would need to determine the maximum current output we could produce domestically, how much we could net import, and how much we needed for the war effort. While in normal times, we operate with significant underutilization of capacity. During the war, Keynes, 1940, argued, we move from the age of plenty to the age of scarcity, since what is available for consumption is relatively fixed, assuming growth of output would go to the war effort. At the same time, more output produced for military purposes means more income, which, if spent on the goods available for consumption, would simply push up prices. Hence, some of the purchasing power would need to be withdrawn through taxes or deferred consumption to prevent inflation. Thus, Keynes rightly viewed taxes as a tool for withdrawing demand, not paying for government spending. Footnote 3. As Keynes, 1940, argued, quote, a government which has control of the banking and currency system can always find the cash to pay for its purchases of home-produced goods. End quote. The problem comes after the government has purchased them. Quote, the government's expenditure necessarily remains in the hands of the public, the government having taken the goods, out of which a proportion of the income of the public has been earned. There is nothing on which this proportion of income can be spent. End quote. And if it is spent, it will drive up prices without increasing real consumption, which moves that income to profits and taxes. End footnote. He thought taxes could be used to withdraw half of the added demand. The other half would have to come through savings, voluntary or forced. Keynes thought the voluntary savings approach would only work if everyone saved enough, which could not be guaranteed. If households did not save enough, spending some of their increased income, they would simply bid up prices. As a consequence, they would consume the same amount of resources, but pay more for their nominal income for it. The business profiteers would get a windfall income, a portion of which they would save and a portion of which would be taxed away. So businesses would act as tax collectors for the treasury, taking away even more of worker income than what had been already taxed. Footnote 4. Keynes noted that he intends no insult in his reference to profiteering. The extra spending must either go to profits or taxes, given that the supply of consumer goods is fixed. Keynes, 1940. End footnote. Footnote 5. As the tax rate on profits would be higher than that on wages, the profiteers become, so to speak, tax collectors for the Treasury. End quote. Keynes, 1940. End footnote. Thus, through the voluntary savings approach, saving and taxes would still withdraw demand, but on the backs of workers. If workers demanded and got higher wages, the process would simply repeat itself, with workers trying to consume more and pushing prices even higher. Wages would be constantly playing catch-up with price increases, with workers still consuming the same amount of real resources. Keynes' preferred solution was deferred consumption. Instead of taxing away workers' income, which would prevent them from enjoying the fruits of their labor and possibly reduce support for the war effort, he proposed to defer their consumption by depositing a portion of their wages in blocked interest-earning deposits. Footnote 6. What he describes is something like individual retirement accounts allowing early withdrawals for emergencies, loss of job, illness, support of dependents, that would amount to approximately 20% of wages, with the deferred rate progressive, such that lower income workers receive a higher deferred payment in the future relative to wages. To reduce the burden on lower incomes, he would provide a progressive family allowance. He suggests it would work like the social insurance system. Below, we will recommend a proposal that would tie the deferred compensation to Social Security. End footnote. This solution would avoid inflation, while at the same time more evenly distribute financial wealth toward workers. Furthermore, this would solve the problem of the slump that would likely follow the war, as workers could increase their consumption after the war at a measured pace, spending out of their deferred income. Keynes recognized that it is not easy for a free community to organize for war. It would be necessary to adapt the distributive system of a free community to the limitations of war, when the size of the cake would be fixed. One could neither expect the rich to make all of the necessary sacrifice, nor put too much of the burden on those of low means. Simply taking income away from the rich would not free up a sufficient quantity of resources to move to the war effort. Their propensity to consume is relatively low, and they have the ways and means to avoid or evade taxes. But taking too much income away from those with too little of it would cause excessive suffering, especially in light of the possibility they would face rising prices on necessities. To avoid a wage price spiral, labor would have to agree to moderate wage demands. This would be easier to obtain if a promise were made that workers would not be permanently deprived of the benefits of working harder now. In other words, the choice facing workers is to forego increased consumption or to defer it. They should understand that the inflation tax is the most burdensome alternative. It shifts excess spending to profits generation. Instead, in return for working more now, they would be paid more later, accumulating financial wealth in the meantime. He recommended 3 principles to guide war planning. 1. Use deferred compensation to reward workers. 2. Tax higher incomes. And 3. Maintain adequate minimum standards for those with lower incomes, such that they would be better off, not worse off, during the war. When the war ends, the deferred compensation would be released in installments, meant to be timed with the slump that would follow the war. The system would be self-liquidating both in terms of real resources and of finance. As resources were withdrawn from the military sector, they could turn to civilian production, with the deferred compensation providing the income needed to purchase that output. Keynes, 1940, also recommended a capital levy equal to the liability of the deferred compensation. Quote, if public opinion still feels a difficulty here, quote, end quote, he wrote, to allay fears about the public debt, it would, quote, bring in an amount sufficient to discharge the liability in respect of deferred pay, end quote.